So I love having these conversations with you, James, right? Because I'm all about making sure that I'm really educated so that then when we talk to consumers in the market, they kind of know what's going on. And everything's always changing, right? In the property market and the mortgage lending market. So picking your brains for a minute, kind of what's going on right now? What's the big picture?
The big picture at the moment is it feels like it's all fairly steady, like a fairly steady ship. We've seen some huge changes and some big adjustments for people. Obviously, we saw the interest rates kind of rocket up to a level that you and I would perhaps see as normal, but very much people were not used to that being the normal. So now the rates being around that sort of 5% mark is where historically they would always that would have been a good interest rate. But we saw them shoot up, and that was quite scary. I always think the media did quite a good job of making that even worse for people.
Mhm.
Actually, that became quite good for us because people were expecting really, really bad news when we were speaking to them, and the reality was it wasn't quite as bad as yes, it wasn't good, and it was very expensive for some people, but it wasn't perhaps as bad as people were expecting.
So the, the
But they
old the
shot up.
old headlines are there to terrify, but you're there to clarify, right? So that people, when
Yeah,
they actually understand the real news and the real information, it gives them a bit more confidence.
yeah, absolutely. And you and I have talked about the mortgage terms that people can have and how extending that can help affordability and make things cheaper. We'll probably talk about that more another time. But yeah, so it wasn't as terrifyingly bad as people perhaps thought it was going to be. But yeah, after the interest rates kind of rocketed up, we actually had to put some new systems in place because we saw the banks slowly bringing their interest rates down very, very regularly. And we actually had to put a system in place to track that happening so that we could get better rates for people during applications and stuff. So those slowly came down, and now we've seen them start to just sort of creep up a little bit. But the interesting thing is that creeping up wasn't a response to anything that monetary policy committees have put in place. It was more competition within the lenders, and I feel that that is leading the way for perhaps a little bit of a reduction in the interest rates again,
Yeah.
for those to perhaps start coming down. And the general thought at the moment is that we are going to see some rate reductions. We don't know how much, we don't know when it's going to happen, but the general thought is that is going to happen, which is great news for everybody.
Is
So
that
yeah,
is
so
that
it
tied
feels
to the is that tied to the monetary policy meeting that's coming up in the summer?
so. I think again with the banks, I feel they put those rates up a little bit in readiness to see what happens there. If the monetary policy, if nothing happens, if they leave it where it is at the moment, then competition within the lenders will see a little bit of adjustment in the interest rates. If we see that rate come down when they meet, then I think we're definitely going to see the rates start to get really competitive and come down quite a bit. Nobody's expecting them to go up. So let's not dwell on that because we don't think anything's going to happen there. It will they come down? Will they stay level? I personally think they're probably going to stay where they are for the moment for this
Okay.
meeting, especially
And
with the
and
election
and
that's
the
happening and stuff.
and the Bank of England monetary policy stuff is separate from what happens in the government, right? So that they're separate things. So despite the fact that we're coming into an election year and the election happening in just a few weeks' time, there
Yeah.
should we shouldn't draw like parallels to what happens with the MPC. Is that right?
No, that's right. I think it was 1977. I think this policy was brought in where I need to check my dates. But yeah, so basically the government can't influence the monetary policy and what they do. They it's categorically cannot influence. So particularly elections, they can't suddenly go, well, let's make borrowing really cheap for everybody and make us look wonderful, purely to prevent that happening. So no, that will not have an effect on what the monetary policy meeting will do. But of course, what governments do and the confidence in our country, that will all have a knock-on effect to what happens to the economy, and then the monetary policy will have to adjust that accordingly. They'll have
Right.
to react to those things happening.
Okay.
So no, that shouldn't really affect where we are on the mortgage front, on the rate front.
But what I think you said there is really interesting is that depending on what way things go with the election, that could affect general confidence overall, which might make the bank consider their rates in order to reinstill confidence. Is that kind of what you're saying?
Well, not so much that it's obviously a change in government can have an effect. We're talking about inflation. The monetary policy meeting that they meet to control inflation, and that's obviously doing pretty good at the moment. It's very under control. So if something happens and that knocks the confidence in the market, that then could have a knock on to inflation, and the monetary policy would have to react to that. The banks themselves are not interested at all in what's going on in government. They're interested in profit, and making themselves competitive against each other. So we see it all the time with these rate rises. They use the rate rises with the banks usually happen quite sharp,
Right.
and they all kind of knee-jerk reaction up, and then everyone sort of watches to see what's happening, and the banks will monitor what's going on, and then one of them will sort of go, actually, we can come down a little bit, and then of course the others follow, and that competition kicks in, which is great when that happens. I love it when that happens because it's kind of like, it feels like we're winning a bit more somehow.
I love it. I love it. So let's talk specific about let's do a bit of a deeper dive on what those rates look like right now. So what can you tell us about the overall kind of mortgage market and what rates we're seeing?
Yeah, so at the moment, roughly 5%. We're looking around about 5%. Obviously, all of the banks have different interest rates. Some will have higher rates because of the type of products they've got. The underwriting processes and criteria for these lenders will have differences in that sort of stuff as well. Loan to values will make a difference. There's lots of factors that are going to dictate what interest rate you're going to get. But if we said roughly around about 5%, it would be a good interest rate at the moment. I've got my screen up. Santander on a sub 75% loan to value, it's 5.08% at the moment. So if we'd had this conversation probably 3 months ago, we would have seen those rates at more like 4.5%. And
Mm-hmm.
when we think about it, nothing has really happened to encourage that gap or to encourage that rate to go up, which is why I think they're poised to bring those rates back down. So I hope we're going to see those rates come back down to sort of 4.5% over the summer.
All right. So this is a clear example of where you're sort of seeing the rates actually go up a little bit with the expectation that they'll then come back down again.
Yeah, yeah,
Right.
yeah, absolutely.
And
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 really,
is there
in
a difference between like the term of the loan in terms of how long you borrow for, or is there a big difference in terms of loan to value, or is it all
yeah,
pretty
so
much on a level?
there's a few interesting things around, I think, loan to value, and also the how long you can fix for. That's something that I think we've seen quite a big change in. So historically, everybody would have had a 25-year fixed rate. The 25-year fixed rate came back from the days when everybody had an interest-only mortgage with an endowment that sat alongside it. So that's why this sort of 25-year exists. And what would happen, and beyond that, then people were just having repayment mortgages, but 25 years ingrained in our society, or it has been. It's perhaps not so much with younger people buying and stuff, but so 25 years was sort of the benchmark for having your mortgage, where you can go up to 40 years in your term if you want to. So what would happen is you'd have a 25-year mortgage. In five
Yep.
years' time, you might move house. You have another 25-year mortgage. So you're already up to a 30-year term. So the term now is really changing. So we're seeing people have the term that suits their affordability, not what is the norm. So that's really, really good. The other thing this is really strange. It's the first time I've ever seen this. A 5-year fixed rate is currently cheaper than a 2-year fixed rate.
Oh,
Predominantly, we've always been told you're buying security. So you're
yeah.
buying a 5-year fixed rate, it's going to cost you more because you're getting the security.
Right.
The banks are taking the risk that they might lose out. That's on its head at the moment. So a
Oh.
5-year fixed rate is cheaper than a 2-year fixed rate. Um, I think that could be careful what I say here, but I think that could be an indication that banks also think the interest rates might come down.
Ah, interesting. That's fascinating. And let's talk about your specific customers. Like, give me a sense of what's the ratio that are doing refinancing, what's the ratio that are new home buyers, first time buyers, and what's the ratio that are porting their mortgages over to a new product because they've moved house or something. Give me a sense of your customers.
It's it's a really very evenly split at the moment. So there's quite a few first time buyers around, which is great, and more encouragement hopefully can happen for first time buyers.
Yeah.
And that's really, really good because we need that to keep obviously everything going, to keep the wheels in motion. And we want people to get on the housing market. So we're seeing a good number of first time buyers. We're then seeing a huge amount of product transfers. So lots of people coming to the end of those 2-year fixed rate or 5-year fixed rates that were very, very cheap, and having to adjust to these new interest rates. And lots of product
Mm-hmm.
transfers happening. Again, an interesting thing, I think. Uh, we used to see fewer product transfers because the banks targeted new borrowers. So it
Yeah.
was better to remortgage away from your existing company to a new one to get a better deal.
Yeah.
Now the banks are giving you really preferential deals on a product transfer to stay with them, so that's quite good. Yeah, lots of sort of second time movers, people remortgaging their main residence to release, to put that into a buy to let, release some equity to go and buy another property. We've got quite good incomes at the moment. The income levels are pretty good, so that's helping sustain people's ability to get mortgages and the level of mortgage they can get. So it really is. That's not a very exciting answer, but it's right across the board. We're seeing a good
Good
chunk
mix.
in each section at the moment.
That's good. And because you mentioned a minute ago, obviously now inflation is under control and things are looking pretty good. I'm sure that's helped with confidence and it's helped with people's kind of monthly expenses. So is this lending to the kind of the good environment that we're seeing where people are not so stressed out in terms of their monthly costs? Is that one of the things? Okay.
Yeah, I think everybody seems to be taking things. No, there are people clearly that are going to be struggling, and it's all very well for me to sit here saying, my customers are doing very well and that sort of stuff. Of course, there are people that I'm not seeing because they can't even get a mortgage and other things going on. But generally we are finding people have been really resilient to what's been going on, and it's all looking quite positive. I have to. It feels very positive at the moment. It feels good. I think the biggest problem we have at the moment is lack of properties on the market. To be honest.
Well, I mean, it's interesting, isn't it? Because from my perspective, we're actually seeing a few more things coming onto the market now because it's a seasonal business and because it's coming into the summer months, and we're seeing a little bit more inventory, which is good. But I think again, it's an opportunity to help educate people, right? Because if we can educate people that actually there are good loan products out there, it is a fairly safe and normal market. Inflation is under control, and it's a good time to borrow. Equally, if from my perspective as an agent, we can encourage people that there's always buyers in any market, so it's a good time to sell. If you're ready to move, let's have a conversation. So finally, let's talk about. And I know you don't have a crystal ball, but it sounds like what you're saying is we're entering into a fairly kind of normal environment, a fairly sort of consistent environment. Is that true? Kind of is that the picture?
Yeah, well, this is the new norm.
The
This
new
is
norm?
these interest rates, sort of 4.5, 5, maybe 5.5%. As things go up and down, this is the new norm. The norm has been interest rates around 1.5%,
Yeah,
2%.
yeah,
Very very low. So this is the future. This is where we expect it to be for the foreseeable future, really. But yeah, so that's it. It's steady. And it should stay steady. There's no reason why that should really change. World disasters and horrible things like that. But yeah, no, it feels very steady. It feels very confident. Sun shining, and people are
yeah,
wanting to move. And on that note, I think we've said this before. Um, Go and find out. Go and if you're thinking about moving house, go and speak to someone like you or someone like me. Find out what you can do.
yeah.
Have the knowledge, and if you don't do it, that's entirely your choice. That's your but
Absolutely.
find out what's going on and find out what you can do because it might be you can't do it now, but maybe next year, you plan to make things happen for next year or the year after, or so just go and get some information and see how it looks for you individually.
I think that's bang on advice, and I think that obviously there's so much going on, and there's the war in Ukraine, there's the situation in Israel, and all these things, but actually they don't necessarily impact these markets as much as we would think. What's more important is that confidence. And so going back to what you just said, is that if people can go out there and consult with professionals who they trust and get the latest information that's relevant for them, then they're in a position to take action, right? They're in a position to make decisions, and that keeps the market moving. So well said. Well, this has been great. It's always so valuable to get these updates, and so thank you very much indeed, James. Appreciate it.
Well, enjoy the rest of your Friday and have a great weekend.